Hi everyone, welcome to this week's edition of Midweek Market Update. I'm Ashley Rosser with Victory Fiduciary, and today what we're going to get into is just really talking about these market movements that we've really been seeing. Kind of started in the middle of December, then the Santa Claus rally came, and really since January we have seen markets under considerable pressure. Now, for January, markets were down between 8 and 10% across the different indexes. February has been some better, but still seeing selling pressure. And so everybody, wants to know, like, hey, what's going on? Is it going to get worse? Is it going to get better? And really the answer is nobody really knows. Okay, so what we can do is look at what history has shown us, look at the math and the rules that we have, and then use that to kind of help us make educated decisions along the way, essentially. And so what I really wanted to do today, though, was have a discussion to make sure that we're viewing this current pullback or correction kind of in the right lens, making sure that we're taking a step back and really viewing everything in with the right context so that we can kind of make decisions moving forward. So first thing, just really want to talk about, okay, declines in the market, they're necessary, they're normal, they have to happen for a normal, healthy market. Markets cannot continue to just climb higher and higher and higher. They have to pull back in order to, essentially, it's almost like if you can imagine markets taking a breather or a pause, then it can kind of gather itself and then move again. When relative strength in the market gets too elevated, too deviated, that things can fall apart very quickly. So these are all normal market movements. When we look at a history, though, of market pullbacks in the S&P 500, we can start to kind of make some educated predictions on how often we'll see certain pullbacks. And so we know that a 5% pullback in the S&P 500, we can expect to see about every 40 days or 3 to 4 times a year. So the most recent one was October. So actually we're kind of like right on track for that one now, October of 2021. Now 10% pullback would be in a correction territory. Anytime we get to be 10%, that's considered a correction. And so we expect to see that every 16 months or so. So just under every year and a half. Last time was March 2020. And so 50% or more, we can see about every 3.25 years. Again, March 2020 is the last time that happened. S&P 500 was down over 20%. And so 20% or more every 5.5 years or so, and that was back again in 20. And so the idea here, though, is that these market cycles are normal. And I realize that right now, for some, this might feel super painful, super scary, because we don't really think about the market moving up 5% quickly. Like, that doesn't really make us pause, hey, is something going on here? But as soon as we see that market start to cool off or pull back or correct, then all of a sudden we start asking questions. So I really want us to kind of keep this lens on as we go through the rest of the information today, that this is typically all what we would see in a normal market. So this is a technical chart of the NASDAQ, kind of looking back over a year. A couple things I want to point out. You can see we had corrected originally before. This was kind of back to before the end of the year. Then we had a real nice run up with the Santa Claus rally. RSI right here, though, was extremely extended. So remember, when the market gets too overheated, when price action moves too quickly, the market, it's almost like, remember, you stretch that rubber band as hard as you can stretch it, it's going to snap back just as hard. And so here we see that rubber band absolutely snapped here. So we've seen a very steep correction in the NASDAQ. NASDAQ back in January was down over 10% at one point. It has recovered quite a bit since then. As you can see here, we're still underneath the 200-day moving average. So that's something to watch. We really want to see us be able to get up and close above that 200-day. That'll give us some more support here. Yes, this does not show Tuesday's action of this week. Today is Wednesday as I'm recording this. And so we did close quite a bit higher. Right now, markets, they're down in the tech index, but really marginally at this point. So that's the NASDAQ. The Dow, you can see, so we've seen that same type of corrective process. Now here, RSI was slightly elevated, kind of coming into the pullback here. So we've absolutely seen some sharp sell-offs here, not quite as sharp as the NASDAQ, but again, certainly we've just been under pressure for the past few weeks. Now here's the S&P 500. Now this chart, instead of looking back a year, I'm looking back 6 months because there's something important that I saw when I was doing my data analysis that I think is really important. Here, toward our bottom here, where, and again, absolutely is painful, nobody likes it. But if you go back to the lows back in October, you'll see we are literally just about sitting at that same area. So while, yes, this feels steep and painful and concerning, we're really just back to where we were in October. And so I think sometimes when we can kind of look at the big picture of that, then maybe this doesn't feel quite as hard. Nobody likes to see negative performance in their portfolio. And over the past few months, there was really not a whole lot of places where you could be and not have negative performance. Just some had less negative than others. And so I think it's important that for us to kind of see that what we are looking at, what things are pointing at, that these are normal market movements that absolutely, though, were being driven and being accelerated by outside pressures. So remember, we talked a lot last year as markets were extended, and we kept saying, hey, markets are extended here. They're continuing to run, but all that's going to take is a little bit of gasoline on that match, and it's going to light up. And this is kind of the same thing that happened back in January. We saw the geopolitical tension came to a head, particularly this month. We saw inflationary pressures continuing to really kind of spook investors and continue to just concern across the board, because remember, inflation, it affects businesses' profitability. It's continuing to affect the supply chain. And so we're seeing these supply chain bottlenecks begin to free, but we've got a lot of just back end that needs to kind of get filled in before we can kind of be back in a more normal state when we talk about supply. And so there's been a lot of headwinds for the market and I think inflation is probably going to continue to be one for the foreseeable future. And then the Federal Reserve needing to act on that inflation and having to be more aggressive with things like cutting, with the rate hikes that have had to come, and they're talking about maybe even need to accelerate some of these other programs, bringing them to an end sooner, which again is really what was responsible for a lot of the sell-off that we saw in January. But I think it's important to remember markets were already extremely deviated. And so it was almost like they were just waiting for that outside pressure to come in to kind of trigger it. So watching things very carefully, absolutely, but I think that if we can continue to get up above the 200-day and hold that, that'll be a bullish signal for us. Certainly. Something I also want to talk about is, despite this that we're experiencing right now, this black line is our bullish trend line. This has not even come close to being deviated. And so the idea is that we want to make sure that if this trend line stays intact, that is another bullish signal for the market. It's a signal that the markets will likely continue to push higher. When this trend is violated, then it's a signal that it's likely that prices will continue to fall. We go into a downward trend line. So for now, we are still in a bullish trend line. I think that there's a lot of headwinds, and you need to really be careful about, where your areas of exposure are right now. I will say, if you were really uncomfortable these last couple of weeks, then you may have had too much risk in your portfolio. So this is a great time to really evaluate. Make sure that your positions all have a job. All of your positions should absolutely have a role. And if you're not sure if that role is still being satisfied, then this is a great time to kind of check that out, because every one of your positions, you should know why you hold them, and you should know if they're still working. Because if they're not working now, they likely are not going to work in the future as we kind of come out of this. And so, which brings me to my last point here is, advisors are really in an interesting situation. So a lot of time, especially with individual clients, we use bonds and portfolios to help us kind of hedge risk. It allows us to kind of add some stability to portfolios. And that typically works out very well, except for when we're in a rising interest rate market like what we're in right now. So bonds and interest rates tend to have an inverse relationship. When when interest rates go up, bond yields go down. That has absolutely been the case for the past 6 months or so. And so it's been an interesting time, because you're using bonds to try to hedge risk. So when you see the Vanguard Total Bond Market Index down 6% over the past 6 months, it's not doing its job, at least temporarily. So, we've had to pivot, and so we had a feeling that these things might be coming. We've been using a high yield bond fund. We've had this since for almost 2 years now. So that's held up very well. So that's great. It's only down 1.2% versus 6%. But again, it's holding up well across the board as far as bonds go. Still negative, and the same thing. We're using a inflation protected bond fund, which is down only 4.7 versus the 6 that broad bond index fund is down. So it's an interesting time, and it's I guess my caution to you is that this is really not the time to get complacent. So just again, make sure you're watching. If you're monitoring your own portfolio, you just really want to make sure that you know what you own, why you own it, and if you should still hold it. So that is the things that I was hoping to get into today. As always, we always welcome your feedback, your calls. If you have questions for me, you can always email me at ashleyr@victoryfiduciary.com. We really enjoy getting that feedback from you. And so just really looking forward to the rest of the year. We'll be coming at you a couple times a month, showing you just where the market stands from a technical as well as a fundamental basis, as well as bringing in additional guest speakers and having some additional topics. So thank you so much for joining us today, and we will see you next time.